Right, good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays. Today, we will step away from the Trump rhetorics you hear in the media every second of every day and discussions on what you want from the budget this afternoon, and we'll have to wait and see if anything gets approved. And we will rather have a fresh look at thematic investments. What is that all about? How you bring it into multi-asset portfolios, and we'll also introduce you to your new fund manager. This morning, we will be joined by Francois Botha, Chief Investment Officer at OIG Investments, and a little bit later, Greg Bailey, CEO at Southchester Investment Managers. Good morning, Francois. How are you doing?
Good morning, Eugene. Thanks for having me. I'm very well. I'm looking forward to hopefully interesting discussion.
Definitely, and thank you so much for joining us this morning. We're always very grateful for all our presenters' time. Like I mentioned in my introduction, you're going to be looking at thematic investing. And I think in the Q&A afterwards, we can unpack a little bit more in terms of how that comes together when you construct portfolios. The floor is yours. We're ready for you if you are.
Right, thanks, Eugene. Just quickly want to share my screen here. Can you just confirm that you can see it clearly on your side?
Perfect. Yeah, full size, perfect, ready to go.
Great. Good morning, everyone. Thanks for your time. Thanks for joining. As Eugene mentioned, gonna quickly touch today on thematic investing, what it's all about, how we think about investments, especially with the thematic part to it, and then hopefully at the end off with some interesting things that we're busy with outside of investments. And hopefully you'll find out of interest. And then obviously afterwards there will be question and answers. Then we can delve into more specifics. Just on the business overview, quickly going to run through this. I think OIG, we currently managing 13.6 billion of our clients' assets. We're very thankful of everyone that is invested with us. And yeah, I think it's a privilege to look after people's money and hopefully help them to live a better life, and when they retire one day, that they're not too concerned about their retirement. So that is a huge thanks to all our clients for trusting us with your money and with your investments. The team, I think the team also broadened out quite a bit. Not going to go into every name and every face on the screen. Just important from my perspective, I think it's a well-educated, knowledgeable team. Team is, as I mentioned, broadened out over the last couple of years as the assets has grown. We've also invested in the people that look after the money, but also then the distribution side, the operational side, and marketing side. I think you need all these different departments to make a successful business. If you come and meet us, then obviously we'll introduce you to everyone in the team. Just I think what sets us apart from a business perspective, we are active managers with that 13 odd billion that we manage. It's most of it is in active strategies. I think especially if you see the volatility that we received over the last couple of weeks, I think active management will definitely outperform again in future. We're also very keen on using hedge funds. In our model portfolios, we do have a large allocation to hedge funds. Obviously, with Reg 28, you are limited to the amount that you can use in Reg 28 funds. But then there's also other strategies that we include hedge funds, and there we will have much more than the Reg 28 limits. Important there is, especially like living annuities, just the smooth return profile that hedge funds can create in a solution. And then the topic for today, obviously, thematic investments. I think it's key themes that will shape markets and shape markets in future, and I'm going to touch on a few of those. And as I mentioned, hopefully you'll find it interesting. So yeah, what is thematic investment? How do we think about the world? What is at the back of our minds whenever we construct a portfolio? And I've highlighted three of these themes for you here. First one is demographics. I think we all know that people are getting older, they're going to live longer, and that has certain implications on what you consume, on healthcare, on where you live, on what you drive. All those things have can change depending on the age of the consumer. So interesting points there. If you're 60 years and older, the number of people are more than it's 962 million in 2017. It will be 2.1 billion by 2050, and then triple to 3.1 billion at the end of the century. As I mentioned, people will definitely live longer, and that will have an impact on the consumer and what the people are actually consuming. I think technology is probably the one that's best known. How things change and how quickly things change. We've seen over the last couple of years how quickly everyone adopted to ChatGPT and all the other amazing technologies that got produced over the last couple of years. And I think that's definitely something to monitor from your investment side as well. And then the sustainability part of it, moving into green energy, wind turbines, solar panels, like in South Africa, I think every one of us got solar panels these days. It's those mega trends that you have to capture and what you have to monitor by doing a thematic approach. I'm going to give you two or three examples of companies that has changed over time, and I think it also highlights if new developments come into play, that your research and your manager must be on top of those changes. So the first one I think is a well-known company to all of us, called John Deere. Producing these green tractors. I think everyone knows about that. Just a bit of history on the company. They actually started off in 1837, and they produced plows and not tractors. They only started producing tractors in 1918, and that was after John Deere actually passed away. So even after his death, they only started with producing tractors. But they were also adaptable. They manufactured bicycles in 1819 when there was a cycling boom. They moved into bicycles. Not sure whether those bicycles were also green of color. It probably was. They also produced snowmobiles. That was in the 1970s, and then they supplied the Winter Olympics with snowmobiles in the Winter Olympics. And it's from the snowmobiles that this phrase comes from, nothing runs like a John Deere. If I ask you what the company is doing today, I think everyone would say, yeah, they're producing tractors. And yes, you're right, they are producing tractors. In our view, it's much more of a technology company. I think they're selling data to farmers and not just the tractors. I'm going to delve into that just quickly on how we see the technology improved within John Deere. So as I said, it's almost like a data company that they provide to their consumers. It's AI-driven data, precision agriculture. So on the front of these big green machines on the tractors are small devices like your cell phone's got a facial recognition on the front of these tractors. They've got a device that when the tractor moves over the soil, it immediately sees which is a plant and which is weed. So as it moves over at the back of the tractor, it will give the plant water, and it will put Roundup or whatever they put on weeds to kill the weeds. So immediately you save on water, you save on the amount of Roundup that you put on the weeds. It's more precision farming. It increases your yields as well. Autonomous machines, I think we all know about autonomous driving, but these tractors, they can go through a land on its own without a driver. And these days, you can even move the tractor from one piece of land to another piece of land that is 10 or 20 kilometers away. So completely autonomous in that sense. I've talked about pest control, disease control with the, call it facial recognition for plants. They can increase yields as well. So now you've got these green machines running all over the world, not just in South Africa, and they collect data from all the farmers all over the world. So if you're a millet farmer in Bloemfontein and you drive on your land, that green machine can take soil samples, puts it in the database. John Deere can contact you and say, listen, there in Brazil is a farmer that's got more or less the same soil than what you've got in Bloemfontein, but the farmer in Brazil yields are 10 times the yield that you have on your farm. Perhaps you must change this and this and this. So again, it's selling data to the consumer. And I think this is the type of investments that we like. It's not just the normal way of thinking on John Deere tractor manufacturer. It's how can you use your database? If you're selling to farmers all over the world, obviously there's data involved. How can you use it? Next company, Novo Nordisk. I think everyone's aware of Ozempic, the drug that they manufacture. Novo Nordisk, specifically in diabetes treatment that they do research on. They came out with a drug Ozempic for diabetes, but then the consumer actually realized it's really good for obesity and weight control. And that's also got changes. And I think there you must also think about the changes on the consumer. Lower demand for fast food and alcohol. I think people use less, or there's less demand for fast foods now, especially on alcohol as well. Healthcare, obviously, it's got an impact on healthcare. Obesity will become less. There'll be less cost on medical schemes, on medical equipment, etc. So have to monitor the impact of that, and then also on your lifestyle. As people lose weight, they tend to get more fit, eat more healthy. It's those type of trends that you have to capture. And then the last bullet point on the slide there is the supply chain. Obviously, there was a massive demand for this drug. There's long waiting lists. And then they've also partnered with Aspen, our local company, to start producing or help them in the production. Again, local company can benefit from global trends. The last part is a bit more interesting if you're not that interested in investments, just again on how technology can have an impact on conservation, and that is where Optimum and OIG specifically are involved. Is to take this theme and make it more practical in our everyday lives as well. So we've got a partnership with Contemplate Wild, which is a non-profit organization. What they do is currently operate quite extensively in Kruger National Park. We've tagged over 1,000 animals. On the right-hand side there, I show you all the different animals that we've tagged and collared. Obviously, I've taken out the rhinos. You can call me afterwards to ask me how many rhinos there are. But now you've got data on all these animals, where they are, how they operate, how they move. Data can be used to capture their behavior, when they do certain things, and you can use that with conservation. On the top right-hand side, also using AI to identify patterns on certain animals, like your hyenas, cheetahs, wild dogs got unique patterns like your fingerprint. So if you monitor these animals in a pack, you know exactly which animal belongs to which pack and how many should there be in a pack, because you've got data now on all the animals. How does it work in practice? Again, you've got data on the right-hand side. That's actually a wild dog running around there in a certain part of the Kruger. We do a lot of snare removals in the Kruger, snare removals, high-risk area. And then on the left-hand side, as soon as that wild dog runs into a high-risk area, a WhatsApp gets sent to the head ranger, telling them the coordinates of the wild dog, where we think the pack is currently, and which ranger is the closest to them to go and see if the pack is fine, if there's snares on the animals. Also, not just focusing on wild dogs and on animals, we also put a lot of effort into the ranger monitoring. So in any given day, there's more than 300 foot soldiers in the Kruger. They all wear now a device that we can see exactly where they are. That device got a panic button on it. The battery lasts more than a week, so that's a major advantage. Because normally your two-way radios, that battery needs to get charged every day, and there's not cell phone reception everywhere in the park. Our devices can give you the panic button at any point in the Kruger. On the bottom right-hand side is you can now start to monitor where your patrols are, you know where your rhinos are, you can start to manage this whole system. And then obviously it's call it a life-saving device as well. We had two panics. Hopefully we won't get any more. The one was a guy that went after a rhino to just dehorn the rhino. The rhino died of natural causes. Unfortunately, he cut his leg quite badly. He couldn't move. Pressed the panic button within 22 minutes. Our response team with the helicopter was on the ground and managed to help the guy. The other ranger at the end of last year got mauled by a buffalo. Also managed to hit the panic button, and the helicopter with medical help was there within 20 minutes. So I think that's quickly just on things that we can do outside of investments that we involve, but it is the thematic approach, the thematic thinking that we apply to not just investments, but also things outside of the investments. Key takeaways, we believe thematic investments is the structural trends that you have to monitor. I've given you 3 examples: demographics, technology, sustainability. And I think the second last bullet point there is just the world is changing. I think your investments must adapt to it and just be constantly aware of these changes. Hopefully we can make your investments better, but also the world a better place going forward. I'm going to leave it there, and then obviously we can have questions at the end. Thanks, Eugene.
Pancho, thank you very much for that. And like you said, at the end, the world is definitely changing. And maybe we need to shift our thinking as well in terms of how we invest. I really want to get into a discussion with you on how this works for investors and how do you bring this into investment solutions. But first up, I'm going to give Greg joining us now from Southchester to give us an overview of their company, what they're all about. They might be new to the audience, but they've been running funds since 2015 and with some hedge fund thinking as well. Greg, I just want to check, are you on the line?
Thank you very much. So I first want to, let me lead on what we're going to start off with. We are a niche fixed income asset manager based in Cape Town, although we do have a satellite office in Madeira. We've been operating since 2011, 2012, in fact. What we're going to focus on now is our one global US dollar fund, which is on the FundRock platform. We're going to talk about our Optimum Income Fund, which is on the BCI platform. And then we're also going to talk about another worldwide qualified investor fund, but that is still new, but we want to give you a sneak preview right at the end. I would then like to introduce my 4 colleagues that are joining me, and that is Andra Greiling on the right, our chairperson, on the left, sorry, our chairperson, me, and then Jaliza, our chief investment officer, and then there are 2 others, Bertus Enslin and Taryn Crick, who've also joined us today, and you can see them here in the team photo. We are a team of 11 people, quite a sort of intensive operationally, the portfolios we run in our fixed income models and so forth. I'm just going to give over to my colleague Andra, if she could actually take us through the investment philosophy and then further history of our business, please.
Thank you, Greg. No, thank you for that. As you've said, we are very niche and only in the fixed income space. We manage a few products and we also then manage some CIS hedge funds. We are specifically always focusing on liquidity. I think that is one of our very strongholds at this stage, and that makes the arena that we play in very liquid and a very good investment type of alternative, even if it's in the hedge fund space where there's always liquidity available. And I mean, myself have been in the markets for many, many years in that specific space. And we do always say that that is one of the areas of the market that you are always sure of, that you can actually get some funding available on the short side of the market. We do not compete with the traditional institutional fixed income clients. We do have two products that we do show them from time to time, issuance programs that we also run, and that's on the one side of our business, and then we focus specifically on the fixed income hedge funds on the other side, being a local hedge fund, and then also the global hedge fund that we're specifically going to focus on today. Thank you, Greg.
This is just a history.
Maybe Jaliza can run us through this quickly.
Thanks, everybody. Yeah, I also can't share my video. I don't know why, but it's just from a AUM growth viewpoint. At the moment, we're sitting at about 21 billion assets under management, and we've seen a steady growth in the assets, and we're very thankful also for the incredible support that we've been having from a wide range of various different investors, mostly on the institutional side, but for some of our products also coming through from the retail. So if we quickly just run through the portfolios, I want to talk about specifically our global income segregated portfolio. It is Section 65 approved, and this is the one where Fundrock is a South African manco associated with it. We're looking at an indicative rate of actually receiving SOFR plus 3%. That means in real terms, we actually did about close to 10% for the 12 months to the end of January 2025. And this is the specific fund that we want to talk about. It's a dollar-denominated fund. And just a quick overview of some of our RAND funds. Worldwide, we will touch on, and then our Southchester IP Optimum Income Fund. This is a fund that's now obviously also moving onto the BCI platform, and that's a tax-efficient income fund. But Greg will touch on that a bit more in the next slides. So Greg, over to you again.
Thank you, Andra. Jaliza, excuse me. If you could just maybe take us, so we can just quickly touch on the dollar global segregated fund. Suffice to say, it was launched 3 years ago, has a solid 3-year track record. It is recently been Section 65 approved in South Africa, so we are able to market it. And as Jaliza mentioned, it's on the Fundrock Manco, but also internationally administered by Apex. So all part of that group. Important things to note that it requires a minimum investment of $100,000 and it's international. So to invest, one has to invest abroad. We're probably going to have to run through these slides very quickly given the sort of time constraints, but would like to just say to you, if it's something you're interested in and want to find out more about, please do get hold of us, and we're more than happy to come through for one-on-one meetings and to take you through all the details. Jaliza, if you could just maybe go back to the previous slide just to show the history, I mean the performance history. So if you look at the left-hand side of the performance history, you will see that the performance wasn't that great. And the reason for that is that we'd started in COVID and didn't have the full set of, let's say, investments instruments available to hedge and things that we'd planned to. And that's a whole long story. But suffice to say, once we got everything sorted out, the track record has been very consistent over the period, and is in fact very similar to a RAND strategy we manage in South Africa. And for sort of conservative investors or building block in dollar funds, we feel this is a very attractive proposition. given that the underlying investments we hold are developed market banks and so forth. So we do not invest in risky credits and all those kind of things. Thank you, Jalisa, has just taken us to the slide. So if you have a look at the slide, you'll see these are all well-known international banks. We do still have a bit of residual exposure to the South African government. That's their dollar exposure. This is something that we are planning to sort of, as those assets mature, we will not be replacing them, so that this can be just a pure international, primarily banking financial services offering. You'll notice Investec right at the bottom, and it's important to note that this is Investec PLC, the British bank, which is investment grade, not Investec South Africa. So Investec PLC actually has a higher credit rating than South Africa, and it's a very good niche bank. Of course, being South Africans, we know the group pretty well. Jalisa, if you could maybe just take us to the performance history again, sorry. Back that previous slide. That just summarized, no, not that one, the other one with a summary of, this one. So that just sets out the fee classes, the annual performances over the last 12 months, which Jalisa said was close to 10%. On a rolling 12-month basis, it's 8.8%. Reason it's come down a bit is because globally interest rates have been coming down, but we still feel that is a very competitive and compelling dollar return for a low risk portfolio. I think we need to probably hear. Yes, sorry.
Sorry, Greg, I just want to come in and just point out that this is the performance for Class B. We've actually launched Class A in 2022 already. So if anybody wants to see the performance history since 2022, which is what we show on the previous slide, just to give more history, we can very easily take you through that as well.
Thank you. Important point there. Jalisa, I think if we can then head on to the next one. I think, is there anything else we should say still on the dollar fund, you think?
No, I think, Greg, maybe just touch on our sneak peek into the future.
Yes. So this is a qualified investor hedge fund with Fundrock. It's a South African offering. And this sort of has elements of what we have in our long-only tax-efficient portfolio. So this portfolio will primarily invest into our dollar portfolio. We'll then hedge the dollar exposure to rands, and then also invest in local fixed income instruments in order to pay costs and things and so forth. But because the foreign investment will be treated on capital account, this portfolio will, in a way, grow on a capital basis. It'll have very low distributions, but the economics will be similar to an income fund. What I mean by that is a steady, regular growth, but will be treated on capital accounts. So we believe this will be a very interesting, tax-efficient, low-risk offering for investors out there. And again, if this is something that would interest you, please come talk to us about it. Jalisa, anything you'd like to say on that quickly?
No, I think that leads very easily into our long-only multi-asset income fund that is on the BCI, or moving on to the BCI platform, and that is a tax-efficient income product. Yep. So it's just a nice lead into it, Greg, if you want to take it further.
Thank you, Jalisa. So although we started in 2011, 2012, it was purely in the institutional area with securitizations. This particular portfolio was our first collective investment scheme. And although we did say earlier on, we do not compete in the long-only fixed income market as far as unit trusts go, this is an exception because it's a specialist mandate portfolio, a tax-efficient portfolio. There are only sort of 3 big players in the market. And it has a nice long track record, and we've distributed through institutions. So that's probably why many of you wouldn't have heard of us in this market, given that it mainly is distributed through lists and 1 or 2 lists and so forth. The portfolio is at 2.7 billion, just under 3 billion. And it sort of aims to offer at least 75% of STEFI after tax. The income component of the distribution is primarily dividend income, say 70 to 80% dividend income, with the balance being interest income. And on an after-tax basis, thank you, Jaliza, you read my mind, it is quite compelling as it relative to what you'll receive on an after-tax basis for other low-risk income funds. So target market being corporates and individuals who want a low-risk liquid product. Again, if that's something interesting to you, please come speak to us and happily take you through that. I just wanted to sort of carry on with the other theme is, we have been around, but why we are not really known in the retail market. And that's because up until now, our distribution base has been purely institutional. And even this last portfolio, although it has a retail profile, we've really had distribution tie-ups, one or two big institutions, and that's going to change a bit now. And we would love to be able to talk to you about this. And we feel this could be interesting, as a building block.
Clients on a direct basis. Should we say anything else on this, Jaliza? Maybe we should just talk about the underlying portfolio composition of this optimum income fund. And it is extremely low risk from a capital point of view, capital protected, it's liquid. The underlying investments are with the big banks or big financial institutions. We do have quite a big component of hedged equity, but the base cost or purchase price of the equities is hedged. So in other words, we'll never get less than what we paid for them to protect investor capital. Of course, by buying that kind of protection, we're giving away most of the upside and really only receiving the dividend income. We also have what are called redeemable preference shares. They're sort of a hybrid between equity and debt, the income being dividends. And again, the redeemable preference shares are either issued by banking groups, and if not, they will be supported by banking groups or large institutions. Now, this just gives a sort of a
idea of the preference share components, who they are and who supports them, and then our fixed income investment component. You may ask, why do we have such a sort of a big interest-bearing component in the portfolio? And that is to provide liquidity and make it easy when we receive new investments to be able to park them while we find new investments to make, which are dividend yielding and so forth, and not easy to come by always. And even if we decide to go hedged equity strategy, there is a process of putting it in place and so forth. Thanks, Jaliza. Maybe we could just show the sort of the hedged equity portfolio just quickly. I don't know if you can all see that, but that sort of gives the list of hedged equities we have in the portfolio. And it's ever more being weighted towards the big banks and life insurance, the corporates. And that is because they are dividend yielding and reliable and so forth, and also a lot more cost effective to hedge. So again, over time, a lot of the small exposures to some of the corporates and things that you see at the bottom will get smaller and smaller and smaller, and it's going to be concentrated in the big equities. Thank you, Jaliza. Are we allowed to ask for questions and so forth?
Well, Greg, I don't see any questions from the audience at the moment. And maybe for our audience sake, maybe just to take one step back, being part of the Apex Group, one of our mancos are Fundrock. We also have Sani as the hedge fund manco. You are going to see some new introductions of companies like Southchester and different ways in looking at asset management. Definitely some very interesting thoughts that came through in your presentation. One question coming in from the audience, Greg, and I'm going to pause it after that question. How do you hedge the equities?
Okay. So in short, you have what is called a put option. So that is an agreement with a bank or financial institution to buy back that equity from you at the amount you purchased it for, in the event that the price of the equity is less than what you purchased it for, or on a particular date. So you can get put options which are only effective on a certain date, or you can get an open put option, which is, you can exercise at any time or after any time. But they're quite, it's a well-known derivative or hedging instrument out the market and is used quite extensively in the institutional market. Problem being is put options are very expensive, as you'd think. So you've got to think of ways to reduce the cost. And one of the ways to reduce the cost is to effectively give away the upside on a particular equity in order to pay for the cost of hedging it. Does that make sense?
Yeah,
Again,
it does
if
indeed.
it's something,
So more derivative based. One more quick question. Why use prefs when they're being phased out from the audience?
Okay, so the prefs, those are the listed bank prefs, which were a sort of a narrow component of prefs. There are a lot of other preference shares other than the JSE listed prefs. So most of the prefs we're looking at, in fact, are unlisted, and also most of the prefs we look at are redeemable. So they're not perpetual, and which means that they go on forever. So with redeemable prefs, there's actually a redemption date or a maturity date where the issuer of that pref has to pay it back. And we typically look at 3 to 5 year periods. Yeah.
Greg, definitely strategies that we are not, or that we don't see or get exposure to in every day. And to our audience and how it works, if you want to know more about Southchester and how they manage assets, very interesting indeed. All their hedge funds, although it's qualified hedge funds, we can get you in touch with either Greg or Chaliza. Greg, Chaliza, thank you very much for joining us this morning, and Greg, safe journey further.
Thank you. Nice meeting you.
Thank you.
Good stuff. Thank you
Thank
very
you,
much.
everyone in the Apex, and for everyone who listened. Keep well. Hope to chat soon.
Thanks a lot. Francois, if I can maybe get back to you, a couple of questions from the audience and my side. You had a very interesting presentation on the theme-based investing, and a couple of things that, well, I learned a few new things, but I just tried to bring it home in terms of fund management and investment management. At OIG or Optimum, you run a couple of solutions. Income funds, cautious, balanced, worldwide flex mandates, and there's a couple more as well. I see you are in the hedge fund space as well when it comes to solutions, or do look at that for inclusion in solutions. But let's maybe look at or focus on your balanced fund, and we can maybe go to your worldwide flex a little bit later as well, because your asset allocation there at the moment, very interesting. But let's look at your balanced funds, and if you talk about thematic investing, how do you bring it home, and how do you include it in a fund, and does that translate into good performance or performance for clients? I mean, that's ultimately what people want to see.
Yeah, Gene, excuse me. I think the part that we also focused on, obviously, I just talked about the thematic approach. We also combine thematic with valuations. I think valuations are important for us. So if we look at different asset classes, like in our balance fund, whether there's local equities, offshore equities, bonds, fixed income, it is underpin is definitely valuations as well. So starting point, asset allocation as per normal, I would think as per normal asset manager, make your asset class decisions based on valuations. But then within those asset class decisions, I think there you can bring in the thematic approach. So to give you an example, let's say we look at retail stocks, and you look at a Woolies versus a Pick n Pay, for example. Valuations will play a part again. Starting point, which one do we think offers more value? But then also having the thematic approach, and with those two companies, we know Woolies bought Absolute Pets just the other day. Consumer these days, especially younger people, they tend to spend much more money on their pets. And some of them don't even have kids, or they get kids much later, and the pets are their kids. So a lot of spending going on in Absolute Pets. And that's a small part of Woolies at this stage. But the trend for thematic investment is that can become quite a decent business unit for them. The same applies for a company like Shoprite. Just before COVID, they actually mentioned in their the financial statements that they're rolling out this new thing called 60/60. We took notice of that. Obviously, these days, everyone is using it. The thematic trend there is people want instant gratification. They get it by using an app like 60/60. Recently, we also saw they're rolling it out now to Shoprite businesses, not just to Checkers. So I think there's a combination of normal valuations, but also with that mindset of what can be the longer trend. If we talk about healthcare, listed hospitals in South Africa, as we mentioned, we think you're going to live longer. Might not be with all your original parts. You might just replace some of your parts, and you're probably going to do it in a hospital. I would definitely advise you to do that. That can have a massive impact on the hospital industry. I know there's NHI hanging over the head. All of those things we consider, but that thematic long-term trend is something that we monitor within our portfolios.
Very interesting. I just want to check quickly when it comes to asset allocation. And again, if you look at a multi-asset portfolio like your balanced fund, which is in the multi-asset medium category, not high category, are you at all influenced by macro and macro events when you look at your tactical asset allocation? And if so, where are you at the moment? Are you underweight, overweight, global, SA equity?
Yeah, Gene, definitely. I think during the last week or so, you definitely realize in markets how quickly macro events or macro policies can have an influence on all different asset classes. So I think you have to take that into consideration. We do that. In that balance fund, we are definitely more focused on the local asset classes. We still think equities in our local market offers decent value. Our bonds yield, the real return that you get on bonds are very favorable. We still think there's upside there. On the global side, underweight US, been underweight US technology companies. Obviously, that hurt in the last couple of years with that Magnificent Seven having decent returns. But you can see how quickly things change also during the last week or two. So yeah, I think. In summary, more SA focused at this stage, but yeah, things change so quickly these days. We'll have to see whether there's other opportunities now after this sell-off and volatility that we saw in the last week or so.
Looking at valuations, you're 100% right. I mean, if you looked at the top 20 in the S&P 500, the MAG 7, they're definitely trading at massive valuations. And yes, there is a bit of FOMO there if you didn't have significant exposure, but you dodged a couple of big bullets the last week. But when you look at valuations, but you look at things like, for argument's sake, China at the moment, offering very attractive valuations. Some people say it might be the best investment for the next 10 years. And some people say China is uninvestable. Your views?
Yeah, you're spot on. I think that's the two camps that we currently have on China. I think there's definitely a bit of shift. I think the meeting that the president had with companies like Alibaba, it shows you that they're much more open for foreign investors. They're willing to support these companies. I mean, a couple of years ago, overnight, the Chinese government just decided you're not allowed to make any profits of educational companies, and those companies went to zero. And obviously, for investors, you don't want to be invested in a company if government can just take away your profitability overnight. But it seems like they're realizing that they must be a bit more market friendly. I think they're also under pressure for economic growth. And I think those things will change the mindset. And then you're 100% correct. The valuations are attractive. I think you can get global decent companies for cheaper valuations than what you can get in other parts of the world.
Definitely. And sticking to asset allocation, I mean, some fund managers are keeping a lot of dry powder at the moment and saying, they want to see what's happening with US bond yields, where that's going, what's going to happen with the trade wars. It's going to become a tit for tat game. Every day there's something new or not new. We're getting used to some of the rhetoric going on at the moment. Where are you in terms of growth assets in general? Are you leaning towards more conservative side at the moment? Waiting perhaps for things to crack, and you can maybe say Monday wants that crack, or can it go on? Or are you a little bit more positive on growth assets over the next 12 months? Where do you sit?
I think in the South African market, I think we're definitely more pro growth. I know our GDP growth isn't that great, and some of the estimates aren't that high in any case. But I think our companies did actually very well during a period of low growth. And if you look at their earnings, they're also coming off a really low base. So if we can get just some earnings growth, I think that will reflect quite nicely in the share prices. So on South Africa side, we're definitely more towards the growth part of the market. On the global side, with uncertainty, not knowing which policy will change, where the tariffs will be, what was said today, will it still be the same tomorrow? I think in that scenario, it pays you to be a bit more cautious and a bit more defensive.
Tend to agree with you there. I want to go to your worldwide flex fund, obviously an open mandate. Typically, you can go 100% SA, 100% global growth, or bonds or cash or defensive. If I have the numbers right, and I do need to apologize because sometimes we sit with secondhand information, just looking at your foreign exposure, it appears that your bond exposure is very high. Just talk us through global bonds, and do you have very strong positive views in that sector?
Yeah, Eugene, I think that the fund is even though it's in a flexible, worldwide flexible mandate where you can basically buy anything you like. We use that fund specifically for people that want to externalize their money and have a conservative dollar return. So within dollar returns of 4 to 5%, very conservative. They're happy with that. So not as flexible as other funds in the category. And to give you the 4 or 5% dollar returns where global yields are currently, I think it's a much easier task than a couple of years ago. But that is specifically for people who want to externalize their money, but still have a conservative, safe, not as volatile offshore exposure.
I think that nails it, because it's specifically why I asked that question, because you're sitting with the benchmark of inflation +3, which is very different from the other multi-asset funds or the worldwide flex funds. And it is a mixed bunch in that category as well. You need to really understand what kind of mandate you are buying into in that category as well. And it does make sense because you're targeting a very specific audience there. So if you're looking for more conservative return profile in a worldwide flex kind of scenario, that's perhaps a fund to consider. Francois, the clock caught up with us. I think this was a good introductory presentation from your side, lifting your skirt a little bit in terms of your thinking and your asset allocation views. Your audience, you know how it works by now. If you need to know more about Optimum or OIG investments, get hold of us and we can get you in touch with Francois and his team. Francois, I'm going to pause it there and thank you again for joining us this morning. It's been very insightful indeed. And we hope to see a little bit more of Optimum and your investments in the near future. Thank you.
Thanks, everyone. Thanks for listening.
Fantastic. Just maybe a quick reminder to our audience, next week, Wednesday, the 19th of March, we've got Belondolozi on global bonds and Ses Fakili on property. Property remaining very topical in client portfolios. Do we need more or less? We'll definitely unpack that next week, Wednesday. And following that, a special session or a hedge fund webinar on the 20th of March. Don't forget to register for that. Always interesting to see where the hedge fund managers are coming from and what their views are going forward. Thank you all for joining us this morning. And we'll see you next week, Wednesday, and hopefully the Thursday as well. Have a super week further.